Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, to discuss if options open interest on multiple tech stocks is potentially causing a gamma hedge trade. And Phil, this is so interesting to revisit this topic just a few weeks since the last time.
Yeah, and in reality, it's the same thing happening. But we woke up this morning and most of the market was pretty close to flat, but the tech stocks were up again, and we've seen that the last couple of days. The tech stocks have been up much more strongly, really on not much extra news. And so one of the theories is that there's quite a lot of open interest in options, in single stock options particularly, in these tech stocks. And so what ends up happening, it looks like it's a lot of calls, which means that whoever has sold the calls to the people that are buying the calls has a hedge on, and that hedge means when the stock goes up, they need to buy a little bit more to keep hedged, and when the stock goes down, they need to sell a bit to unhedge. And that, of course, means that the rallies get extended in the tickers with a lot of option open interest on the call side. So when you look at the charts, we've had record options volumes this year. That's a fact. And when you look at the charts, you can see an increase in all kinds of option trading, but specifically in single stock options, you can see a much bigger increase than in other spaces of index and ETF options.
And so moving along for a COVID-19 update, and this is what's been my biggest concern since I think it's our 28th or 29th week that we're into this, is not understanding what it looks like when you have a weakened immune system or antibodies don't protect against future infection. And we're starting to hear more now where a couple of people have been confirmed with reinfection.
Yeah, I think it's important to keep it in perspective, though. There's about 37 million people that have been infected. So the few cases that people are reporting as reinfection cases really is an incrementally small percentage. Some of them, they've had slight variants on the COVID disease. So, it's kind of mutated slowly over time and they've recorded another mutation, but not every human has the right antibody reaction. And so it's possible a couple of humans in the world don't actually have the ability to defend themselves against these sorts of things in the future, and they might be the ones that are getting infected. It's not like 50% of the people that have had COVID are getting it again. So it's not nearly as bad as the headline suggests. But what is bad is the spike in cases that we're seeing across the states, especially the Midwest states at the moment, are seeing much higher infection rates per 100,000 people than a lot of the coasts. So there is still COVID spreading throughout America. It's actually spreading throughout a lot of the middle of America. And it's the start of potentially a second wave this time because all these states have seen it once already, a little bit more like what we're seeing in Europe.
All right, moving along, I love these kinds of charts. When we take a look at gambling odds in politics, you can essentially put odds on anything these days.
You can, and actually, if you look at a lot of the academic theories on gambling or crowd betting, it's much more accurate than any expert opinion will give you. So the fact that you have groupthink, all putting money to work, should give us a pretty reliable indicator of what's going on. And obviously, we talked yesterday about the fact that some of the industries that would benefit from a Biden presidency had started to outperform, some of the green space and wind farms, things like that. So you can see the betting odds have started to change materially. And that's one of the other explanations for why the market's been rallying, just because we might have a sweep, which is going to make it much easier to pass stimulus next year and get things back on track because we won't have the sort of bipartisan politics at play that we have now.
Right, and speaking of getting back on track, you have to be concerned about corporate credit risk and the rise of bankruptcies on the horizon.
Yeah, it's one of the most common questions I get when I'm doing, sort of meetings and panels with the industry these days is where's the credit risk and where are the bankruptcies? And the reality is there is a spike in bankruptcies. We know from the banks that they've been provisioning and they potentially have over-provisioned based on what they're doing to provisionings this quarter for credit exposures. And you can see the black line on the bankruptcy filings. We haven't had that big an increase in bankruptcy filings considering the dramatic reduction in GDP and the impact on the economy from COVID. But if we look at the historic bankruptcy filings, we actually see that there's a pretty long lead time or lag time, I guess, depending which way you look at it. And it's usually about a year and a half later that you see peak bankruptcies. So that speaks to the fact that we've been talking a lot about the headwinds and worrying about longer term unemployment picking up and worrying about the fact that, we might actually have a more classic recession and we might have more credit risks next year to worry about than right now.
All right, Phil, thanks for joining us on Trade Talks.
You're welcome, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.